Jesse, thank you very much. And everyone, thank you very much for your time today. We had a nice early start. We've covered panels relating to 5G, to Asian investment CIOs, property, and today we get into sort of the nitty-gritty of bilateral investment. My name is Paul Craig, and I'm one of the founders of the US-China series. And today I'm with Juliana Coyne, who is an associate director at Control Risks Global Risk Analysis Practice based in Shanghai. Mike Edwards, who is the Deputy CIO of Waste Multi-Strategy Advisors, which is a New York-based asset manager, and Scott Kennedy, who's the Senior Advisor and Trustee Chair in Chinese Business and Economics at CSIS. So, everyone, I wanted to talk about the Equitable Act. And for those of us who have been looking at this, and Mike, you and I, first I remember you and I having a conversation about this back in August. And I look at Marco Rubio's proposed bill, which certainly is not legislation by any stretch. But for me, it encapsulates and is a wonderful microcosm into the current debate over bilateral investment. And it is part factual, part hysteria, it's part logic, part xenophobia, it's part practical, part fear. And even if you look at some of the two basic components of this, which is one related to requiring Chinese companies that list on American exchanges to have just to operate under the same accounting standards as US firms, I don't think anyone can argue the logic of that. And then you read a little further, and there's a paragraph in there that talks about preventing Chinese technological ascendancy, which gets into the fear elements and the like. And I may be stealing Anna Ashton of the US-China Business Council's thunder, but Scott, you were on the same panel as her when we had our first event in Seattle in January, and she made the comment that currently in front of Congress, there's something like 250 anti-China proposals. Now, when you compare that to 9/11, there was, at the peak of the legislative push after the terrorist attacks of 9/11, there were 113 anti-terror pieces of legislation that were being proposed. So at a minimum, we are at an extremely hyped level of, I will use the word hysteria, but certainly of tremendous concern, depending on which way you look at this, about where bilateral investment is going. And Scott, I'll start with you with the following. Have we gone too far? And do blanket approaches to investment make sense given the framework that you currently see?
Thanks, Paul, for having me on the panel and for putting together a very comprehensive day's worth of discussions that are sorely needed. I think I share the same concerns about going too far, blanket approaches, not looking for nuance and adapting. But I think that is part of the framework that is being applied by the Trump administration and by others who are certainly fearful of China, of what it could portend, and of today's China under Xi Jinping. And so I think there are some ways in which folks are going too far, and there's a lot of things on the table that the U.S. could do. And I'm worried that a lot of the proposals that are sitting in Congress or in front of the Trump administration will be implemented, and Rejuvenating investment will be one of many things that isn't accomplished. That said, I think what is needed is some more balance in American policy that understands that there are risks from globalization, from interdependence, and that we need to identify those. In the 1960s, we saw that pollution was a problem, and for the most part, industry decided at that point to simply attack regulations on pollution. And I think we're at the same point now with regard to investment and other aspects of our relationship. There's going to need to be more regulation about investment, about trade, about other aspects of the US-China relationship, and all of us can either be critics of any of those efforts, or we can help shape those. And so I think a lot of these things, whether it has to do with stock market listings or direct investment, national security review screenings. A lot of these things are going to be adopted no matter what. And so I think what we can do is try and shape them, make them more nuanced, make them more practical, so we can both address the demands and needs of efficiency and market access, but also make sure we ensure public health, our values, transparency, and things like that. And so I would suggest that we don't just simply throw up a no sign to all of these ideas, but we screen them, we try and shape them in a way that would be as practical and effective as possible.
Right. So, Mike, one of the things that frustrates me tremendously about this quote-unquote investment debate is that we bucket all investment into one broad category, right? And I think, well, I'd like to work out if this question is applicable, but do we need to break up investment into its respective buckets? And I'll give you 4 buckets, which just for the purpose of this exercise. One is the subcategories of public market investment. So this is US state pensions being able to invest in China and vice versa, right? Passive private equity, corporate investment that looks at either A, the supply chain for export, or B, production of goods and service for domestic sale into China. Should we, or is it possible to avoid these blanket approaches and to look at investment in different ways and say, look, an investment by the Illinois state pension in Alibaba is one thing, an investment by Google in artificial intelligence with a company with obvious links to the PLA is something completely different?
Yeah, I think it's a good distinction. And before I start, I'd echo Scott's comments on thanks for putting together such a fantastic day generally, and it's a privilege to be able to join everyone together from a bunch of different locations, which is so relevant for this, and including, and coming to your question, including really now across industries. I think there's an enormous gap. I'd even add I think the point you make on corporate investment as a bucket, and Google's a good one. I'd even add a 5th, which is venture stage investment, where I think it's a place that's probably undercovered in a lot of the hand wringing about CFIUS and FIRMA. That the scrutiny and willingness to take on early stage investment from Chinese and China linked investors in the Valley has suffered very dramatically over the last few years. A lot of it in anticipation of what is now happening and will continue to happen in terms of what the BIS level scrutiny and FIRMA. But I think the ability to at least conceptually both share ideas and share capital in both directions, and thus the ability for US and global investors to invest in some of the transformative technologies in which the Chinese lead. And I'd use as an example companies like a SenseTime in AI. That's getting dramatically suppressed more by cultural norms, I think, than by legislation. It's the anticipation of that risk that is, having certainly entrepreneurs that I speak to frequently, the first call they make is not to their bankers, it's to their lawyers. And that change in behavior and practice is obviously suppressing cross investment. But I think it's also creating a worrisome environment for the exchange of ideas. I mean, to Scott's metaphor on pollution, I think there is the idea that because it's a useful narrative to say that the U.S. and China are in a quote unquote tech Cold War, not my term, but obviously emerging in the policy zeitgeist, that it's necessary to be a cold warrior by excluding anything with any risk associated with it from the capital raising decision making and from banking and VC networks. And I think that part of the problem with that is there are a lot of very positive sum and very acceptable realms of collaboration available. So I would suggest that maybe a distinction within your, if you'll pardon the pun, bucket list would be that what you really want to do is think about the places that you can have at each of those levels, corporate, and I'm thinking more about corporate and venture. You can have protected collaboration versus not. It's sort of flipping the notion of an entities list or an unreliable entities list on its head, and having areas where you could, sort of proactively, not necessarily promote, but defend or allow collaboration. And just final comment, my personal view is that public investment is in an entirely different sphere, where you're not in a market for corporate control or influence or anything else like that necessarily, and you're just a liquidity provider or liquidity consumer. And I think that should and frankly is, as of now, subject to a very different set of rules. So I would distinguish that first category you
right. But Scott, should we distinguish? If Senator Rubio is to be believed in terms of his wording, if part of our objective here is to stop Chinese technical ascendancy, should that matter whether or not the dollars come in the form of a venture capital investment from Sequoia or from an investment in the public equity of Tencent via a state pension or US firm as a whole?
I think if you use his logic, then the goal is to stop Chinese tech ascendancy because they're inherently a strategic competitor, and anything that makes China more powerful is risky because for the United States on all certain grounds. So he would use different tools to constrain those different kinds of investments. He'd apply FIRMA toward investment in China, even not just investment in the United States. But the basic framework would be the same. I think a better approach is to actually still try and force China to play by the rules that we want them to play by, with regard to transparency, with regard to keeping civilian technologies out of the hands of the military, and those type of things, avoiding IP theft. And I think the rules that we have currently are designed to do that type of nuanced, careful policy adaptation, not blankets, bans across the board. I think we're not prepared for that. These tools can't do that, and so we would be going down a very steep, slippery slope if that's the goal. I think we do need to find ways to mitigate a whole variety of risks that come from investment in all different directions. And so I would think that reframing the conversation around how we mitigate these risks and enforce high standards would be a better way to go. It would be more consistent with your idea of being more nuanced and targeted towards a different type of investments and in the different types of sectors that Mike pointed to.
Got it. So, Julia, I look at this pretty much from I put my pro-globalization cap on, and basically I personally think that if left up to the average business or the average consumer, they would embrace globalization. The average consumer wants choice, and if I want to go and buy my Italian olive oil, I want access to my Italian olive oil. And if you're the companies that work with you, what their primary goal is profit margin. And one thing that is very, very clear, if you are forcing companies either to onshore or providing them with a very onerous regulatory framework, the cost of doing business naturally goes up from where it is today. And one of the things I took away from the notes that you sent me was, in a debate which is overtly negative as a general rule as we stand today. Now, your comments about companies not changing at the moment, that sort of embracing the status quo, was quite encouraging to me. And the point can you talk a little bit about how companies are dealing with the regulatory pressures, whether they're hoping to avoid them or what they can do to circumvent them potentially, but just talk about the attitudes of companies versus the Beltway debate.
Sure, thanks. And I'd like to echo Scott and Mike as well. I think this debate needs a lot more nuance, and it's great to have many panels today that are working to get that. I think you're right. with our clients still seeing a lot of interest in investing in China. People want to stay in China, not just to produce for China, but that is a big part of it. One of our clients last year saw 30% growth, margins that a lot of people think are something from the 90s or early 2000s. And it's a bit strange being the optimist, the cheerful one on a call, being the one based in China. But I think companies are increasingly apprehensive that geopolitics is going to disrupt their business, that political pressure will force them into a zero-sum position, and I think we're pessimistic on that situation getting worse and putting a lot more pressure on businesses. But up until now, companies are considering relocation options, but for the most part, we don't see them executing them. Where there are supply chain shifts happening, they're usually for reasons that predate not just COVID pressures, but also the Trump administration. It's rising labor costs in China. It's tightening regulatory enforcement, which makes, again, China production more expensive for many of these companies. But political pressure is only forcing limited relocation and shifts. But to avoid tariff costs, for instance, we see our clients still manufacturing in China, but finding circumvention through adding a label in a third market, shifting only very strategic parts of their supply chain elsewhere, and actually thinking of where entity listing is limiting their ability for their US business to work with partners in China, actually moving some of those aspects of their business out of the US so that they don't fall subject to those rules anymore.
Got it. And just taking that point a step further, Scott, I mean, one of the things I'm going to speak for Julia here for a second is that what is probably good for Julia's business is an incredible level of complexity, which only comes if you layer restriction on restriction on restriction. How do you avoid that? Well, you avoid that by using a blanket approach, right? So for me, you've got some sort of a really sort of destructive trade-off between either providing a blanket approach across all of these investment strategies, be them public, private, direct, corporate, etc., or what you do is you get a layer of complexity for individual investments and relating to all the potential stress points, and data is a big part of this. But how do you avoid this this onerous level of complexity if you aren't going to use these blanket approaches to the general definition of investment?
Paul, I'm afraid complexity is here to stay, and you're just going to have to expand your legal department, and Julia's going to have a lot of work, and all of us that help advise governments and companies and investors are going to have a lot more work to do. It's not going away. You just think about the biomedical and development of vaccines, the amount of if we want to continue to have sourcing from China, continue to have Chinese companies receive venture capital that Mike and others provide advice on, they're going to have to be able to meet the standards of the FDA, other global regulators. We're going to have make the public and the entire medical community feel comfortable about having Chinese researchers, equipment, materials in the global supply chain and the innovation chain. And so that's going to require a lot more interaction across regulatory spaces. In some ways, may reduce some of the complexity by having greater harmonization and recognition of standards across jurisdictions. So if the Chinese can meet the standards of the US FDA or this US CDC, then it may not require, you may be able to reduce some of the complexity across jurisdictions. But I don't think that you can expect one size fits all or just simply allow this to be industry self-regulation. We're going to have more. It's going to be a more regulated space in order to keep this idea of globalization going forward, or it's going to fall apart as it's being attacked by those who just see all of the risks that come along with it and not the benefits.
Right. And Mike, just taking that one step further, how does, if Scott's scenario plays out, how does that A, not harm innovation, and B, not reinforce the dominance of particularly US and Chinese technology firms? I can only make, what Scott's alluded to is a cost of keeping in line with this slew of new regulation. The cost of implementing that is going to be enormous, and really it's going to be dominated by those firms that have the legal departments and the compliance areas and the data privacy areas that can deal with that level of complexity.
Yeah, I agree with that. I mean, I think even before diving into that, offshoot in terms of the dominance of already dominant companies, I'd make a point just in terms of the sort of reinforcement of complexity in regulatory regimes, which is be careful what you wish for those. And we've singled out Marco Rubio as a sort of a face of the, given his participation or his sponsorship of the Equitable Act. But there's to your earlier point, Paul, with 200 some odd bill proposals and that sort of thing, there are a lot of faces on this, and I would say to them that the idea that American companies are inherently going to be better at American regulations is not necessarily the case. If we think about everyone's favorite punching bag, Huawei, Huawei navigated US patents much more capably than many US firms, and certainly than, in some cases, Nokia and Ericsson, who, at least in Nokia's case, absorbed the most prominent US firms in telecommunication, because Bell Labs, which I assume everyone's familiar with, was eventually bought by Lucent, which was eventually bought by Alcatel, and eventually bought by Nokia. And Huawei, I don't have the facility with the numbers off the top of my head, but Huawei's 5G applications to the US Patent Office were many, many, many multiples, and have been, the number of Nokia's out of the US and Lucent's and everyone else. I believe Huawei has more 5G relevant patents than all US firms combined. That might be slightly off, but order of magnitude. The point I would make is that we set up these hurdles that are transparent, that might have one policy goal, but they frequently do. And if that goal is to dissuade, sort of Chinese participation in American industry, that's not necessarily the case. And I think it's potentially a troublesome insertion of bureaucracy in places, because we've obviously, in a lot of places, de-emphasized patent and copyright as entry points into, for venture firms in particular, and are sort of brushing aside a lot of those requirements now, kind of ex post, really. I think as relates to the dominance of firms with legal departments and this sort of thing, I think we inherently get to a discussion of antitrust, and where how that field is being shaped. People toss around terms like hipster antitrust and postmodern antitrust and all of this, and I think that those are very relevant in contrasting U.S. systems and Chinese systems, because the U.S. hasn't really done much in terms of making dominant networks. Really, I'm more focused on technology, making the benefits of those available to smaller companies. In some cases, those are going to be places that can't navigate regulation and requirements, to your point. In other places, they're going to be, places that are kept out due to network effects rather than brought in. And in many cases, it might be, heretical to say this under the construct of regulatory reform in an investment context, but at least in antitrust and in network access, there's a lot to be learned from some Chinese examples. I think of payments as one area where the Chinese allowed, or the Chinese government allowed, really Tencent and Alibaba to dominate payments and to build networks for digital payments, and then forced opening of code into developers of those networks that spurred innovation. We're not, in the US, we don't really do anything like that and don't have initiatives like that. So there are many different approaches to how we could think about that. But I think if it's going to be if we're going to erect more and more hurdles, we have to think of ways to compensate for that in terms of allowing innovation with small companies in particular that won't have access to both the resources and the networks. And that to me, I think more of networks as being the issue than new regulatory hurdles per se.
Right, because one of the things, Scott, that we talk a lot. Actually, Julia, one of the things we talk a lot about, and we've gone on this conversation. We've talked about U.S. money going to China and how the U.S. can stop that money going there. We've talked about Chinese money going to the U.S. and how the U.S. want to stop that, right? But what we haven't talked about is U.S. money wanting to go to China and the Chinese saying, we don't want it, right? Because I think if there's been, I would say in the last several years, I think the world, particularly in 2018, 2019, said to China, we don't want your money, right? And you look at that in terms of the pushback against Belt and Road, CFIUS reform and the like. China had been this incredible exporter of capital for going on several decades. And really 2018, 2019, the world said, well, we've had enough of this. But does China actually want foreign capital? And if you were thinking, to use our friend Sam Sachs's quote of a digital iron curtain and a more inward-looking China, does China really want that investment? Does China want Microsoft to have a big business in the mainland? Or are we going to get to a stage where, the investments by Tesla in Shanghai are going to be the real exception here, i.e., just that the path for American companies in particular into China is one of a continual deceleration of profitability?
So absolutely, China does want foreign investment. Its intention is not to prevent foreign investment, certainly in the near-term future. It sees that foreign investment as being critical to its post-COVID economic recovery and as being an integral part of long-term sustainability in its growth. It's easy to dismiss some of the recent openings, particularly in financial services, as paying tribute to the U.S.-China trade deal and sort of longstanding commitments that it's made. But underneath that, there is a real desire to see continued foreign investment in China. You raised the point, of course, that there are areas that are more sensitive now, that are more at risk of being politicized. And I think for tech companies in particular that we work with, this is a big concern. They worry that their business here is viewed not just through the lens of the work they're doing now, but through the lens of what role they might play if relations between the U.S. and China worsen. If those companies are then viewed as American companies that represent U.S. interest above all, that puts those companies in a difficult position in terms of building those relationships in China. But that is really focused on a number of sensitive tech areas. Overall, the reception that our clients are getting is very positive, especially at the local level. During U.S.-China trade tension escalations last year, there were several anecdotes of local governments reaching out to businesses and saying, we just want to hear, how is this affecting you? Are you thinking of withdrawing from China? Does this affect your willingness to invest here, to employ here? What can we do to make this better? As part of sort of economic recovery measures post-COVID, there's a lot of tax advantages being handed out to businesses, even on issues where previously local governments were fighting with our clients over sort of the terms of those taxes and fees that they regularly paid. They have now proactively reached out and said, we're offering a discount, a rebate to important investors in our area. We value your investment. We want to continue to see that here.
All right. Scott, just taking that a step further. I mean, we've had numerous discussions when we were planning the event with places like the Washington State China Relations Council, the US China Heartland Association, which frankly, my apologies, I had not heard of until about 10 days ago, and is an enormous organization pushing small companies in the heartland of the United States to do business in China. You hear stories of reciprocity from cities and provinces wanting to do business here, yet we have this beltway I'll use the word blanket, which is the term of the panel, but this beltway overlay, which is extreme negativity and focusing on national security. How do we bridge that divide between what states and cities and local governments want for their own economic development, both here and in China, and what's going on between Beijing and Washington. Can we bridge that divide?
Not today. It's going to take a while, and I think it's going to take everybody to pitch in and do their fair share. Washington's going to need to find a way to find that political space that allows some nuance, that recognizes that you can have a highly interdependent relationship with China, with American businesses going to China, Chinese companies here, and manage it and mitigate the risks and deal with those challenges. And at the same time, we're also going to need the Chinese to step up as well. I agree with Julia that they are offering lots of incentives to encourage new investment and to keep current investors happy and make them happier so they don't go. But the Chinese sometimes have a funny way of showing their warmth and desire, and actually sometimes making folks feel uncomfortable. Operating in China is no easy thing for companies. There are lots of regulations and restrictions about what you can do, lots of limited transparency with regard to how policy is made. Chinese policies now with visas for foreigners is very opaque. There's lots of foreigners or international folks who are currently outside China because they left during Spring Festival who can't go back. And that's making it very difficult for companies to run their businesses. China has huge restrictions on data management and cross-border data flows. So although they want this investment because they want to be part of the innovation superhighway, they also, at the same time, with their other hand, creating problems that may turn China into an investment cul-de-sac. And so, yes, Washington's got to do a lot more to be much more nuanced and find that political space that allows for that. But the Chinese also need to adapt as well. So I think there's responsibility both in Washington and Beijing to make the policy and political environment more conducive to continuing to have a very deep investment relationship. Got it.
Mike, I'm going to put my macroeconomic hat on for a second and say, I personally believe the Chinese have effectively had a closed capital account since the renminbi went into the special drawing rights basket in November. I think it was November 2015. In order to rejuvenate bilateral flows, do the Chinese need to have a more open capital account? Or is that just a naive statement because at the end of the day, with CFIUS regulations being as tough as what they are and foreign investment review boards around the world shooting down investment all over the place for obscure reasons, is there any such thing as an open capital account anyway?
Yeah, I mean, certainly a provocative big picture question in terms of what that even means anymore, in a world in particular of central banks dominating cross-border capital flows now. But without delving into that necessarily, I think that ironically, one of the things that continues to motivate public equity acceptance, as it were, of public equity investment in Chinese companies from outside of China is exactly that, meaning the effectively closed capital account and the difficulty for global investors to reliably repatriate renminbi into their home currencies. And I think that has a lot more, there are a lot more strictures, which we could spend hours on, than just the closed account. Many of them are more bureaucratic, focused on some of the strictures at SAFE and elsewhere. But if you think about what has motivated, why do we continue to get some of China's biggest and frankly best companies issuing ADRs and raising capital on the NASDAQ and the New York Stock Exchange? I think that's the single biggest reason, is really a diversification of the erstwhile greater China investment or investable universe, wanting to diversify as it were, its liquidity and currency basis in Chinese companies. I'll give you an example to watch over the next couple of days and I think it's very important in the sort of cadence of how the U.S. investors in particular think about Chinese the risk of ADRs and things in light of the Equitable Act and what I assume, which we haven't really touched on, but I assume are potentially other micro regulations or micro legislation around VIEs and coming out of the SEC in terms of accounting and that sort of thing, which is the IPO of Kingsoft Cloud. I think it'll be on Friday, which is without offering an investment opinion, a pretty well respected and large cloud provider in China. Not a stage, not a lower tier business by any stretch. And that is in contrast to, I think we always have this, we shouldn't think of accounting scandals and things like Luckin Coffee as one-offs. They're usual. If we were having this discussion a decade ago, or maybe it's 15 years ago, we'd be talking about Sino-Forest and things like that. There's always that, but I think a lot of the reason why we continue to see that is to diversify exactly that issue. So if we were talking about the capital account and will opening up the capital account have a dramatic impact, I think eventually yes, but I think the question is really on what timeline. And I think the Chinese timeline, to the extent that we're thinking big picture from a policy perspective, is decades, not months or years, to lay that groundwork. And, there aren't 2 and 4 year election cycles to deal with. And so you can set policy groundwork, whether it's at SAFE or NDRC or CSRC, very, very gradually to prepare for that. And if I were using a baseball analogy, I'd say we're in the 2nd or 3rd inning of that process. We're certainly not in the 1st, but we're also not in the 7th. And so that's a very, very gradual consideration. And I think we're going to have a whole bunch of debates about much smaller increments, things like, a digital currency, for example, and proliferation of potentially a sovereign blockchain, as it were, and things like that, which will be the groundwork for that eventual opening, but will have very, very meaningful immediate term investment implications and liquidity implications. And I think that's going to come first. So if we were talking on a 30-year time frame, I would say, yep, absolutely, that's going to change everything. But I would also say that's not an investable time frame for any, for most people.
So let's take that a step further. And Mike, I sort of disagree a little bit with you on this, because I think the Chinese have absolutely no interest in having an internationalized renminbi. I think that they've looked at the Japanese example and realized that, again, I started my career looking at Japan many, many moons ago, and on a rolling 5-year basis, I've been predicting the demise of Japan for basically since 1991, right? So, and it never happened. And the primary reason it never happened, even with a currency that was free floating, although fairly strictly, manipulated, we'll call it that, is that 95% of the Japanese bond market was held domestically. And if you look at what causes a financial crisis throughout the emerging world, or any crisis, it has been when foreigners have had the ability to sell your bonds. Be that as soon as obviously littered across the emerging world, but Italy and Spain, Ireland was probably the most recent example of that. Why would the Chinese risk? Or why would the Chinese insert a level of risk for, I'd argue, probably relatively minimal gain to have the renminbi become an internationalized currency? I'm not talking about a threat to knocking off the dollar as the global reserve currency, but even just to allow it to be a free floating member of the global currency world, where currently it is not.
Yeah, I think much as it's less helpful for panels to agree with one another than not, I think I agree with that on any reasonable time frame. I don't think there's a desire to take that risk. And I think that the aspects that you're seeing in terms of what we might call internationalizing are more related to things like the pricing basis for commodities. I do assume that, actually, I assume this has already happened, just not very publicly, that you're going to get large, for example, oil contracts denominated in renminbi, to even remove the risk of relatively small movements, but also to establish that practice. So there's a difference between a reference currency and an open currency. And I realize that sounds like a minor distinction, but I think you're exactly right in terms of not wanting to open up, as it were, vulnerabilities in an already somewhat volatile, if we think about things like WM wealth management products being almost entirely domestically held, but nonetheless vulnerable. I think that the parts you're going to see open, which is, people would act like this is a great breakthrough, which I don't think it is in terms of the phase one trade deal. The pockets of that are becoming available for investment for outside investors, I think are places that just can't, to your point, can't really be destabilizing. And if anything, are problematic and thinking about, global firms and U.S. firms going into. I would take NPLs as an example, which is obviously getting some attention in that deal. I remember back in, I think 98, 99, 2000, that time frame, when the AMCs were first formed to offload debt or do debt equity swaps from the large banks following the crisis in 98. And obviously regulations come a long way since then. But even domestic investors that were trying to put capital in there were liquidity providers into what I would call a regulatory black hole. And I don't think it's changed enough that you're going to see, sort of predictable returns or pathways, or that's going to be the tip of the iceberg that then opens up the broader corporate debt sector and broader securitized bank lending. I just really can't see that. I don't think I think the returns are going to be pretty dire, actually. So I think you're seeing little pockets of opening up in places that are one-offs and are not necessarily the beginning of a meaningful trend where you get that internationalization, to your point.
Right. And Julia, just to take that point a step further, I mean, I think you can count the number of extremely profitable foreign companies in China on one hand. And I look at this in terms of the opportunity sets of China looking more inward, being completely focused on helping sponsor its domestic rivals. And I use the example of in the next several years, SOEs have to divest away from foreign-based technologies, which doesn't bode well for Microsoft's business going forward. And Brad Smith, the president of Microsoft, can say, well, we've got a SaaS model in China now, but if every SOE in the country is not going to use Windows, then you've got a bit of a structural problem to start with. Do American companies ultimately face the pressure from the market itself, i.e., they're just not going to be profitable enough to make this a viable business? And more to the point, does that just make China as an investment destination just puts it in the too hard basket?
Well, I think there's a lot more than 5 very profitable foreign companies in China, and I think for that reason, a lot of businesses still believe in a win-win from this. Otherwise, they wouldn't be here. I think, however, on the political side, on the government side, neither the U.S. nor China believe there can be a win-win. I think they both believe it's a zero-sum, particularly in areas of technological competition. And we do see in that space that China is very concerned about its dependency on foreign goods, particularly U.S. technology, and it's going to keep working at reducing its dependency on that. But I think the extent to which that affects companies really varies. There's obviously certain very high-profile companies, foreign companies that can't operate here. There's companies that sort of get the Huawei equivalent treatment that I think will see their business significantly decline over national security concerns in China in the coming years. But in a lot of cases, and we do surveys on this for our clients, companies may say that they've been told that they should buy domestic where they can, but they don't, because there's no quality to match what they can get from their foreign partners, and in many cases they will continue to buy foreign products unless they're explicitly forbidden from doing so. And I think for that to happen, you need to see a further deterioration in U.S.-China relations, but unfortunately that's conceivable. because I think on that end it can become a self-fulfilling prophecy if both sides believe that that's the direction it has to move in.
Scott, can we talk a little bit about CFIUS and the whole issue of data? And I've scribbled down here that TikTok data is not Boeing data. And I think that if we're going to continue on with this theme about a blanket approach to data, I would assume, is not the right course of action. But it seems to me that it's a easy fallback position for China hawks to look at every transaction through a data lens and to conclude that, well, the Chinese can't have access to our data, be that be that TikTok, be that whoever. Where do we stand? How do we go through this data minefield in regards to CFIUS? And is some data going to be viewed more strategically important than others? Now, I know that sounds simplistic, but as we stand today, we are bucketing data in as one sort of homogenous factor.
Let me try and address that and a little bit about the previous question, because I think it's important, and we can debate the record, but all the data that we see shows that the vast majority of foreign companies, including American companies that have direct investment in China, are profitable. Now, maybe they're lying in all those surveys to AmCham. Maybe they're engaging in transfer pricing to get better tax situation. But the record shows, at least the public record, maybe folks are telling you privately that they're not making money, but China has been consistently profitable and more profitable relative to other parts of the world. And that's why they're willing to put up with all of the darn constraints that the Chinese put on investors when they operate in China because of that. I mean, GM makes most of their money in China, right? And I think Microsoft is the exception, or ICT has a different outcome than others. And there's some places where there could be certainly a lot more. Pharma companies don't make anywhere near what they should because of price controls in China, for example. But nevertheless, I still think folks are willing to put up with so much because China has been profitable, or the chances of it being so are significant. In terms of data management, I would say that so far, I think the U.S. is trying to look for nuance and trying to treat cases in different fields differently, and trying to identify companies that are dealing with data that may have military applications one way, and those that are participating in TikTok or whatever, where the information may be about the users, your credit card information or other information, treat that another way. But they all need to be managed in some way, and without just a total free-for-all. There's got to be some types of standards. I would propose that we have a global treaty on data that sets standards that just delineate across these different categories, give governments different kinds of responsibilities to how to protect it, have rules related to privacy as well. And data we're not going to solve the data issue in the U.S.-China relationship bilaterally. That's going to require a multilateral solution. TPP has some of the solution to it, but not everything that we need. So I think we're going to need a much more multilateral solution that addresses this, and that'll end up reducing then some of the complexity which you're worried about in some of your previous questions.
Right, given that the Chinese data privacy provisions look remarkably similar to GDPR, does that need to be the basis of this global treaty? A GDPR style?
It could be. I think GDPR for some folks just goes way too far, right? And that there needs to be some type of balance. And certainly the Europeans move faster than the Americans. U.S. is oftentimes playing catch up. But obviously, there's going to need to be some type of melding of and harmonization, particularly for companies that operate globally. Google, Facebook, automobile companies, financial institutions that operate around the world. It would be helpful if there's a common standard that addresses some of the key questions about national security, but as well as about privacy, and as well as just simply about operational needs for companies to be able to do business and provide services, so that someone in Sao Paulo and in Kunming can all be part of the same company's service provision without that company having to do cartwheels in one place and handstands in somewhere else.
Right. So I will we have one question here, which I know we've made it as a panel when the question starts. I do a lot of lobbying in Washington. So that's how it starts. One theme this year was both Republican and Democrat senators and congressmen raising serious concerns about state-sponsored cyber, IP, and industrial espionage, as well as various humanitarian causes. Can we artfully negotiate through all those themes?
I'll just give one brief answer and then turn it over to Julia and Mike. I think we can. This isn't the time where we should expect big breakthroughs. I think for this year, we should expect a continued decline in the U.S.-China relationship. We already had the worries about strategic competition. Then we had COVID. Now we've got an election campaign where the two sides are competing for who can be tougher. And so coming out with nuanced ideas that meet the needs of an audience like today's is one thing, but it's not going to what is most likely going to win you a lot of votes. So let's just understand that this year is going to be a difficult year. Hopefully we don't take the relationship and drive it over the cliff. And depending on the outcome of U.S. elections, where we are with the pandemic, at the end of the year, then there may be chance for a reset in the relationship where we address some of the concerns that this questioner raised.
I agree with Scott. I think the outlook is a bit grim for the rest of the year. I think that the companies that are working in this space, that are finding ways to work around these issues, address these issues, are not feeding into most of the stories that you see reported in media, and I don't think they'll be driving the story for the rest of the year. I think it'll be all the factors that Scott mentioned just now.
Yeah, I again, not always helpful to all agree, but I think if there are two takeaway terms from our panel, you had blanket, and I think we have nuance as well, and this is going to be a year devoid of nuance. I do think, and that's unfortunate. I do think at the risk of being a little bit political, I think that this upcoming election, especially the presidential, is going to have significant consequences, not just on the obvious everyone racing to be the most hawkish and to position themselves in that way, but exactly the point you made a second ago, Paul, in asking about whether or not we need a multilateral approach to data. I think the biggest distinction in terms of the way that either an extension of this administration or a new administration will approach the relationship is actually going to be whether there's a rejuvenation in not necessarily multilateralism, but in a multilateral approach, or an approach that uses and engages other countries, both to pressure China in some ways and to build expertise and collaboration in others, versus I think an extension of this administration is going to have a very, very hard time doing that, and that's problematic. But I think the broader issue is, in an election year, we're going to do less, notwithstanding all of these bills and all of the, I think the sort of micro regulatory initiatives around, in particular, out of BIS and export controls and these sorts of things. I think the broader thing that's at risk for the investment environment is really the narrative. And the narrative of whether or not the U.S. and China are I'm very focused on the technology side, but in a tech rivalry that pertains to supply chains as well, or whether there's room for innovation, differentiation, collaboration. And final point for me on that would be that I think that as we're focused on regulatory constraints, we frequently ignore the places where there's an ability for regulatory empowerment, which I think is a place where China has a lot of opportunities to lead and to be in some ways a laboratory for the world. I think autonomous vehicles would be one example. We could go into virology and biotech and that sort of thing, but it's a bit of a hot topic at the moment. So I'll use AV as an example, where I think that the first cities that facilitate autonomous driving are going to require significant municipal regulatory innovation and leadership. And I think that the private sector will rush to fund and use those examples, both on the investment side and the corporate, meaning, syndicated investment, but also on the corporate side. And I think the right question is the first city that has widespread autonomous vehicles, is it going to be, say, Portland, Oregon, or is it going to be Wuhan or Changsha or what have you? I think, in my opinion, it's far more likely to be a Chinese city that can organize, not have to deal with electoral cycles, and bring a public-private partnership to bear. And that is a real opportunity to potentially work on building standards from that base, instead of saying, oh, they've done something wrong and we can do it better, or that sort of nitpicking. And I think that the narrative that emerges in terms of tech rivalry versus, there are different systems and different approaches, and there are things to be learned from all of them, is a huge difference. But unfortunately, to the earlier point, it requires nuance.
Good. Everyone, thank you very, very much for your time. We're going to have to dive into our next panel. And look, this was wonderful, and we will make sure that everyone gets a copy of the recording and a summary of this over the course of the next few days. Everyone, thank you so much for your time.
Thank you, Paul.
Thank you.
Julia, Mike, thanks a lot.
Bye.
Bye, guys.